The first thing we want to talk about is your legal structure. Assume you open up an account, you want to trade. What does that account look like? Are you opening that account in your own name, or are you opening up in the form of an entity? So the first, obviously, thing you can do is open up an account in your own name. That would be a personal account. The problem with that is you are now personally on the hook for everything that happens in the account. And good news is you don't spend any money on me on the front end. We don't form entities. Bad news is on the back end, if there's a problem, you have no protection. So we don't really see a lot of clients opening up individual accounts. The second one is you form an entity. So there's a bunch of different options when you go to an entity. There's a corporation, which could be taxed as what we would call a C corporation, or as an S corporation. There's an LLC, there's an LP, it's a limited liability company, limited partnership, and a trust. So real quickly, before there were LLCs, people would form S corporations because you get the benefit of flow-through treatment on your tax. So in other words, not avoiding double taxation, and you would have that character gain flowing through. So most of you probably know that if you're trading a lot of futures, there's beneficial tax treatment right now on futures trading. You have the so-called 60-40 treatment, which Phil will go into a little more detail. So what most people want to do is they want that tax treatment on their profits to flow through to them. So if you actually form a corporation and you do what we call a C Corp, which is what most public companies are, that's actually taxed at the entity level and on dividends. So you get taxed at a corporate level at a corporate tax rate, and then you get taxed on a dividend. And you would wash out any real character of that gain as it flows through to an individual. So needless to say, we don't really see anybody using that structure. The S Corp, again, was the structure that people used before they had LLCs to get the flow through and also get the protection of a corporation. There are issues with S Corps because they're limited in nature. They have a bunch of restrictions on the amount of types of owners, the number of owners. You can't have certain entities owning, you can't have different classes of stock, so they're highly limiting, and so we don't see a lot of S Corps. What we see most is limited liability companies and limited partnerships. Now the LLCs and LPs are very similar in that they both flow through, and there's a single level of tax. They both provide protection to, in the form of an LLC, their members, and in the form of a limited partnership, the limited partners. The difference is that the limited partner must have a general partner, and the general partner of a limited partnership has unlimited liability, so they can sort of look through the LP and go after the general partner. The benefit of an LLC is the manager or managing member, sort of the equivalent to a GP that runs the entity, has limited liability. So you're asking yourself, why would anybody go with the model where I have unlimited liability versus the model where I have limited liability? The answer is mostly used to be of tax, and used to be that LPs have been around a lot longer than LLCs. So years ago, people were worried about how the IRS and how, quite frankly, state law would interpret LLCs and whether they would actually work, so to speak. People are comfortable with that. So the only reason we used to see people using LPs is really there was a play where you might get set up a situation where you can limit your self-employment tax. Now, I'm not sure that play is still there, but Phil will go into that in a little bit of detail later. So what you're really seeing is an LLC as the most common form of entity. The LLC is very flexible. It allows you to have many different classes of equity. It allows you to allocate equity in many different ways. Okay, it allows you to allocate profit. So you can have someone with a limited interest where they only can participate in their own trading. You could have an interest where they participate in certain of the other trading. And you can have an interest which just participates in, for instance, sale profits, or all of the above. So an LLC allows you to pretty much do whatever you want, assuming it's very clear in the document from an economics perspective. One of the main benefits of the LLC under current law is that you can issue an interest to a member for zero capital contribution. And that's what we would call a profits interest. And what that allows you to do is issue that interest where you can still give that person, even though they haven't made a contribution, still give them the benefit of the character of the gain, so that you can pass on the 60-40. Now that is sort of been under attack indirectly, because I'm not sure if anybody here has heard about sort of the carried interest legislation that's been sort of promulgated, or actually not promulgated but proposed. And what that really was going after was the hedge fund. So Congress and people were up in arms that hedge funds and private equity funds were able to take their 20% incentive allocation and actually get the character of the gain, whereas many of the regulators and many of the politicians saw that as, well, that's really compensation, so why do they get to keep the character gain while everybody else is paying ordinary income tax? So there was movement to try and change the law and tax that at varying degrees ordinary income. And if that would have gone through, because of that type of incentive allocation to a hedge fund manager is essentially a profits interest, that actually would have had the same tax treatment for what everybody does here in the proprietary trading industry, which is issue these interests to people so that they can participate in their own trading. Thankfully, right now, that movement has stalled at the time being, but it sort of resurrects itself fairly often as most of the Democrats look at this and don't really like the fact that a private equity manager or a hedge fund manager can receive beneficial tax treatment. So it's something to watch as we go forward. Usually, when we do LLCs, we as a firm generally like to form Delaware LLCs. And the cost of forming a Delaware typically is you pay Delaware, and then typically you're doing business here in Illinois, you have to qualify to do business in Illinois. So there's an extra cost. The reason we like to do that is Delaware, as a sort of body of law, allows their members to really contract whatever deal they desire, subject to always acting in good faith and fair dealing. So Delaware is not paternalistic at all. It basically believes in freedom of contract. So even if someone views the terms aggressive in favor of one party or the other, Delaware typically will enforce. Illinois, on the other hand, is still what I would call paternalistic. There are certain fiduciary duties that you are not allowed to override by contract. And so think of it, if you're running a firm and you're the manager of that firm and you want to bring in traders and you want to issue a profits interest so that they get beneficial tax treatment, well, now if you're in an Illinois LLC, you might unwittingly be opening yourself up to claims by the trader vis-a-vis the duties that you now might owe to the trader that in a Delaware LLC you can contract away, but in Illinois you're stuck with. So we do typically see a lot of people though, hey, I'm in Illinois, I go out to another lawyer, we open an Illinois LLC, great, why wouldn't we? There's a reason why you wouldn't, and we often, when we represent our clients who have Illinois LLCs, depending on how difficult it is, we'll actually migrate them through a couple different means to Delaware. So something to just be careful about. The last thing I think on this segment is just, there's a couple ways to set up these structures. One is you just form an entity, you open a trading account, you do a single LLC, and you start trading. So that's actually a good start. But for a lot of our clients, it's not sort of the end of the analysis, because a lot of our clients are developing proprietary software algorithms, intellectual property. And what you don't realize is if you're a single entity and it owns all the assets, then all those assets are at risk. So what really does a proprietary trading firm really own? It really has cash to trade. It has probably some excess cash that it's not actually deploying at the time. It's got intellectual property, and it has the benefit of agreements with employees and other service providers. What we typically do is separate these assets out so that we have a trading firm which has the cash and the trading account, and then we have another entity which owns the intellectual property, assuming there's some tangible intellectual property being developed. And the reason for that is if one entity was to blow up, it would protect the assets of the other entity as opposed to it all sort of going down. And vice versa, if there was a problem with the intellectual property so that a certain firm in town who might be aggressive in patent litigation was to go after that entity, it might then protect the trading account. So we will typically set up those entities. We'll then have a holding company so that they're all owned under one structure. So you have holding company, wholly owned sub, one sub owns the trading account, that's the trading firm. That probably usually employs the people. The other entity is an IP holding company. And then we'll get a little more complicated if we have servers in foreign jurisdictions and we want to limit the tax potential of having servers in foreign jurisdictions. We'll put our servers and our hardware in yet another entity and have interconnected agreements. So that's really more advanced planning as your enterprise grows, and it's not always necessary if it's really more discretionary click trading. But as that trading gets really more IP dependent, more quantitative, we tend to suggest that you start splitting up your assets. that we'll turn over to some basic tax concepts.
In terms of trading, you're going to have one of two types of income, either ordinary income, which is taxed at ordinary rates, the top rate being 39.6%, which you hit after $450,000 taxable for a married family, $400 for single, or capital. The capital is either long-term or short-term. If the gain is long-term, it's taxed at 15% unless your income is over 450 or 400, depending on whether you're married or single, respectively, and then it's taxed at 20%. Maybe we can talk about Section 1256 first, which is basically all capital. It's what's referred to as 60-40 income. 60% is long-term and 40% is short-term. If the top capital gains rate is 15%, it comes out to a blended rate, or what used to be a blended rate of 23%. Now the top blended rate would be 28%, which is basically 60% at 40% and 60% at 20%. The products that get Section 1256 treatment are regulated futures contracts, which are contracts which are traded on a domestic exchange, or one of a few foreign exchanges. The foreign exchanges that are applicable today are the ICE exchange, the Dubai exchange, the Life exchange, and as of March 1st, 2013, the Eurex exchange. So if you think about it, your income is such that your trading income is 60% long-term and 40% short-term. The expenses that you incur to generate that income, which might be seat lease, TT, quote expense, are all ordinary expenses. Assuming that you meet the definition of the IRS as a trader if you're an individual, or a trading entity if you're an LLC, that those expenses go against the 40% that's short term. So basically, if you had a large trading entity, let's say an LLC, and you paid your traders in the form of a W-2, then chances are your ordinary expenses will more than offset the 40% of your income, which is short term. The net effect meaning that probably your net income is taxed at right now 20%, what used to be 15%. I was giving a presentation a few years ago to a group of Japanese folks that had come over from a securities firm, and they were exploring setting up a futures exchange, and they tried to find the rationale between 60-40, and that how did Congress, when they wrote Section 1256 in 1981, and then for market makers at the CBOE in 83, come to the 60-40 split? I mean, how was it arrived at? That I tried the best I could to explain was just arbitrary. That it could have been 80-20, it could have been 50-50, and I wasn't getting anywhere. Finally, I explained to the interpreter that it's because the chairman of the House Ways and Means Committee was from Chicago. Before it could be interpreted, the 4 or 5 Japanese guests would go, Rostenkowski. So this is very favorable treatment. Similar to carried interest, is always being attacked. The most recent focus on it came from the chairman of the House Ways and Means Committee, a congressman named Camp. He actually has a paper out explaining that 60-40 has no relevance. For a professional trader, it should all be taxed as ordinary income. They had some hearings in the first and second quarter of last year. Those hearings really didn't go anywhere. They brought in some academics that reinforced Congressman Camp's view on it, and that's the last we've heard of it. That we don't foresee any major tax legislation in 2014, given that it's an election year. But there's always this concern out there that somebody will look at Section 1256 and try to change it, especially for professional traders. In fact, in the president's budget the last 3 or 4 years, he has proposed getting rid of 60/40 treatment for professional traders, as well as getting rid of carried interest.
Chicago apparently didn't help us all that much.
Not at all. But the products that avail themselves of a 60/40 treatment are regulated futures contracts we talked about, futures on approved foreign exchanges, equity options traded in a market maker account, broad-based equity indexes like the S&P OEX, and stock futures which are traded by professionals. And I don't even know if they have stock futures anymore. We hardly ever see them. And also currency forwards, where the underlying currency is also traded as a future at the IMM. Now, in many cases, you trade a 1256 product in conjunction with a non-Section 1256 product. The best example is Treasury bond futures versus cash treasuries. What you have is a straddle. And again, assuming that it's accounted for and the correct elections are made, you have what's called a mixed straddle. On a mixed straddle, you look at the net, you compute the net every day. If the net gain accumulates to be a gain on the derivative side or the futures and a loss on the cash side, then the long-term capital gain can be as much as 50%. If there's a loss overall, the short-term loss can never be more than 40%. If you always keep in mind you want long-term gains and short-term losses, you'll never go wrong. The other area I'd like to talk about is the IRS has spent a lot of time on trader versus investor. I would suspect that most of the people in this room would fall under the definition of trader. People who trade every day or most days for a short-term profit. You're not looking for long-term investment opportunities, and there's a great frequency of trading. What that allows you to do is take all of your ordinary expenses before adjusted gross income. That means that they would not be itemized deductions subject to phase out, and they would be a deduction before Illinois tax. If we could just spend a minute on self-employment tax. If somebody's trading in an individual account and they're trading on a membership, we would classify that income as self-employment, and it would be subject to self-employment tax, which is 15.3% up to roughly $115,000, and 2.8 or 2.9% after that, up to $250,000, and then that becomes 3.9%. Now, that as Lance spoke of a few years ago, there were some strategies to help avoid this self-employment tax, or FICA. With the Obama health care bill, it's somewhat irrelevant, because if you're not paying self-employment tax, you're paying the new net investment income tax. So whoever you are, if you have capital gains, interest, dividends, rental income, really any type of investment income, and your adjusted gross exceeds $250,000 for a married family, or $200,000 for an individual, you're going to pay a 3.8% tax on your investment income. 2013 was the first year of this net investment tax. In the past, if you looked at a strategy to avoid self-employment tax, you would save whatever the Medicare tax of 2.9 for incomes over 115, and the 15.3% on income up to that. But now with the net investment tax, you're going to pay it on everything over 250 anyway at the rate of 3.8%. The other area I'd like to touch on is a 475 election. And what a 475 election is, you're electing to have the income treated as ordinary income and the gain or loss is marked to market. If someone is trading regulated futures contracts or some other 1256 product, you probably wouldn't want to make this election. But if you were trading equities, for example, on a short-term basis where you would never generate long-term because you'd never hold a long position for as long as a year, then a 475 election makes sense, because basically you can mark the positions together or to market at year end, similar to section 1256. And since you're not going to get a long-term anyway, you avoid wash sale rules and a number of other issues. And again, you can have two accounts. If you're an active trader and you're actively trading equities, and you also trade regulated futures contracts, you can, the equity account could be a section 475 account, and you would still keep the 60/40 benefit on your regulated futures contracts. To maybe just kind of take off on a couple of Lance's points. We don't see corporations at all. I mean, there's no reason to have them. Sub-S's are basically extinct. You basically, that you have an LLC or an LLP. And again, the taxation that I just described flows through to all of the LLC members or limited partners or general partner. So to the extent that it's section 1256 income on the entity level, it flows through as 1256 income to the individual. But it's not today, especially for actively traded futures entities, that the driving force isn't so much the tax aspects as it is the CME exchange fee rules. And that Lance is the expert on that, so maybe you could.
What first your LLC agreements might cover, and then we're going to get into how that may or may not impact CME rules. So the main mistake that we see when people form LLCs, which is a good start, is they're a single person. It's hard to get that wrong, right? So, but when you have another partner, what we see too often is very simple LLC agreements, which, you know, there's some benefit to having them simple, but the issue is that then when something goes awry, the LLC agreement actually doesn't deal with it. So let me give an example. So two partners who are really forming a proprietary trading firm come together, and the deal is we'll both be 50-50. Yeah, we're both going to put in equal amounts of money, but we're really only doing this because, hey, you're a great quant programmer and I'm a great trader, and let's build a business together. So that's great. You go to a lawyer, they draft an agreement that says we own 50-50. They probably don't deal accurately with how we run the business together, just because we have to agree to everything. And that's what the agreement says. So now what happens is Phil and I do this, and technically, you know, Phil wants to go and, you know, order a water machine, and as a technical matter, we have to have a meeting for every single thing we do, right? Phil wants to change the paper. Technically, we have a meeting. Now, we all know that no one's going to actually go ahead and have meetings, but what happens is as you start to violate the terms of your agreement, if there's a problem later on, there's no baseline to understand the things that we had to agree to and the things that we didn't have to agree to. So that's one big sort of piece of the puzzle, which is you got to deal with management. Second, although almost more dangerous piece is, so let's assume we formed a firm, we're doing great, I found out, obviously Phil's a whole lot better than this than I am. Say, well, this is great, I'm going to go down to Florida, hang out on the beach, and I still own 50% of the company, so I'll just send my voting address to Phil, send my check, and this is like great thing for me, not so great for Phil. So the agreements, surprisingly, would allow me to do that. They wouldn't have any standards on the duties, the devotion of time, what happens if I violate the terms, so there wouldn't be what we would call buy-sell agreements. So I think the thing to think about as you look at your agreements, if you have them, or as you form them, there are a lot of issues that need to be dealt with ahead of time. And when it's actually going poorly is the worst time, or actually when it's going really well is a bad time. Because that's when people are often looking at, well, I don't want to give up anything at that point, right? Why would I allow you to buy me out at that point when I can go on my merry way and keep my equity? So the time to do that is early on. And just to give you an example, besides setting forth the basic economics, what are our obligations to put money in? If there's a capital call, do we have to put money in? How do we go raise outside money? How the distributions work? Are we sharing in the same P&L? Because we have many deals where, I may get 4% of the overall company if we sold the company, but I get 40% of the trading profit. So that all has to be dealt with in the agreement. But the other ideas of duties, setting forth really what we have to agree to, what we each can do on our own as sort of co-authority, and then setting forth what are our duties. Do we have to devote, it's almost like an employment agreement in some respects. Do we have to devote full time to the business? Do we have fiduciary duties and what we would call corporate opportunities, which says, listen, we can't develop a trade, and then I see, oh, wow, this is a really good thing. If I go do it over here, I'll make a lot of money. Let me just go do that over there. You want to legislate around that to keep people sort of to the deal. And then intellectual property is often missed. If you're silent on intellectual property as to who owns it, you sort of open up the door later on to have claims that someone can leave with your intellectual property. So often our agreements will be very clear. The company owns it, and we'll get into redemption rights, but if you leave the company, you don't take the IP with you. And then dealing with, again, the rules of the road on confidentiality, non-solicits, non-competes, and those type of terms. And then the last thing, again, I think the most important is the buy-sell. Typically, we're covering a bunch of contingencies, but think of the reasons why one partner might want about the other. One is we just can't get along. Okay, and with two partners, that's a bit of a difficult situation because who gets to buy out the other? With sort of an odd number of partners, if two vote out one, that may be a little easier to decide, listen, two people can't get along with the third, and you want to protect the third, obviously, on the buyout. But we have termination without cause. Pause, if somebody's out there not actually doing their job or doing something, violating rules, stealing money, again, you want the right to take that person out of the entity. Death, disability. Again, if the idea is that we're really only doing this together because we're both working and God forbid something happens with death or disability, you want to at least know what the terms say upon that. And often it's you bought out, maybe it's I buy some of your equity out, you keep some of your equity. And then the last two ideas are resignation. What happens if someone says, I'm leaving? Fine, I'll comply with my non-compete, but I'm going to go start a competing business at some point in time. It's not a great partner to have that's actually competing with you and can look at your books and records and participate on both sides. And then the last is retirement. Retirement's usually a little bit further down the line for us. We usually deal with resignation, and then as the business evolves and grows, we say, all right, well, we now have a business that's almost like a franchise. It's very successful. It might be unfair that if one founder that started this business 20 years ago wants to retire, that they should get bought out in full when they built this business and they've got this huge team that really can run the business. So we start to talk about, well, maybe it's fair that we have to take some of your equity out because we do have to have equity to incent the younger generation, but we should have you either hold on to some of it forever or maybe have you sunset down so that you're continuing for a period of time to participate in the profits of a firm you helped build. So those are things we usually don't do right up front for a new firm. We don't really like people thinking about retirement when they start up, but as we move down the road, we usually will go and revisit. So those are things as you guys look at your agreements or think about forming new companies, those are the type of issues to really think through on the front end. The other piece, as Phil alluded to, is really the CME. And so the CME has a bunch of rules regarding their membership rates, which you guys have probably seen. And what they're really trying to do is prevent firms from, in effect, what they view as selling rates to other firms. So they're not big fans of the trading arcades. They're not big fans of firms within firms. But they understand that under certain circumstances, that's permissible. So their rules, if you really look at the sort of fee policy bulletin, all the rules are trying to get at, is this really a trading firm or is this a customer business? And I'm not going to go through all the rules because we'd be here forever and we'd run out of tape, but the basic rules are, 80-20, you can't give more than 80% to the trader. The member firm can't mark up their rates, except they're allowed to increase the rate if it's a reasonable approximation of expenses. So that they can recoup expenses. But if you look at that rate on an overall basis, they can't be making money by increasing the rate. And then, they can't charge capital charges on capital. People can't be liable for 100% of their losses. Really trying to, if you look at common sense, they're trying to say, is this person really a customer or a proprietary trader? The other thing that I think a lot of people miss in the rules is that what I just went through is really more for a single trader, right? So let's think about a single trader, no more than 80-20. Then have additional rules. Well, if you want that trader to get a K1 or a 1099B to pass through tax treatment, then there's rules depending on if you're an equity member firm, you have to have $250,000 of them. And there's rules regarding how long can money stay up if you're not a member, and they're legislating around, are you really an owner or a customer? But then they go a little further, which says, if Phil and I want to trade together as a team, and one of us or both of us wants to get a K1, that gets the CME concerned that that's really starting, as you expand that, to look like a firm within a firm. And so they have their team trading rule that says if more than one person are splitting on an account, and at least one of those traders is getting 60-40 or flow-through treatment, then in addition to their individual split on that trading, those traders have to get a piece of the overall profits of the firm, which makes for a much more difficult conversation with the trading firm because it throws off the economics, right? The trading firm isn't real happy that if Phil and I are flat or even lose money, that if they do well, we're still doing well, right? That's not the typical, very specific trading deal. And so the CME has a lot of rules around preventing that from happening. There are exceptions, there's a lot of exceptions to the rules, but generally speaking, you're going to have to participate on the overall as well as the trading if you want to have multiple people trading the account. Now obviously to a lot of people that's a problem because the way people trade more and more, you're really seeing a lot more team trading because Phil and I, we can't really say, all right, we're trading a complementary strategy and Phil's going to be up and I'm going to be down. So you can't really say, Lance, you get 100% or 80% of yours zero, and he gets 80% of his ups when it could be random depending on we trade. So it's a real issue for the industry, and the CME understands it. They also are afraid that if they don't have this rule in place, they are going to create and affect firms within firms. The other thing to think about when you're actually on the firm side is I mentioned that the CME doesn't want to see this look like a customer business. Well, neither does the SEC or the other SROs. Because there are firms out there who I've seen that will give 100% of the profits to the trader, bring the trader in, give 100%, and then they'll mark up the actual commission. Now, it might be a new business model, but I don't know a lot of firms that trading firms that make money by giving 100% of their trading profit to them. So there's a regulatory issue. For a while people were doing this and there was no real regulatory activity until years ago finally there was a seminal case which was Tuco where the SEC finally said, okay, well you guys are giving 100% of the profits, you're marking up the profit, the commissions, and we don't see you anywhere listed on a Form BD, you're not registered as a broker-dealer, so explain to us how you're actually able to do that, because that's what brokers do, that's what counterparties, intermediaries do. And so finally there was a case, and on the future side, most of the times people are trying to do this arcade structure really to pass on the CME rates. And the CME rules by themselves, if you comply with them, often those rules prevent people from being deemed to engage in a customer business. But on the equities and the option side, it's really more of a leverage issue. So it's really more of, well, if I'm a customer, I'm subject to Reg T, and either I don't have enough money or I don't want to become a BD to create a JVO, or maybe I don't have enough money to get a fully deployed portfolio margining account. So that's why they come into those type of entities, so that trading firm can then pass along its leverage. There, you don't have the CME with their rules overlaying, and so you want to be careful that if you're the firm, that again you have enough sharing going on, and really that the firm's making their profits from the trading, so that you're not opening yourself to a regulatory issue. I don't know if you had any other thoughts on that, Bill, that you've seen just more on CME issues affecting how you do returns, et cetera.
Again, we see most structures in an LLC driven by the CME rules. I mean, that from a tax standpoint, all you need to do is allocate profits where there's economic substance. Economic substance would be Lance and I form a partnership, and I put up all the money, and he does all the work, and we split 50-50. There's rationale to that allocation method. Now let's say that Lance and I form a partnership and he brings his kids in as partners, they put up no money and they do no work. Well, there's no economic substance to allocating that profit. So in most trading entities, how we see is that there's capital partners, and we usually refer to them as Class A partners. Then as traders come in, and that they start off as employees usually, and perhaps they work out a contract or a covenant not to compete, and that we see these mostly for 3 years. And then after 3 years, they would go to one of the proprietaries who are the owners and say, gee, you've been taxed at 23 or 28%. I've been paying 40%. I want to share in this 60-40 income. Again, there's plenty of economic substance to allocate them that. The acid test is usually the Merck rules, and the Merck rules being, Lance is the expert, not me, but I think you have to have $250,000 in your capital account. You meaning the Class B member, to be able to avail yourself of the 60-40 income.
And the CME, again, they started out people on the floor, locals. That's what they started with, and now they're going to firms, and then you introduce high-frequency algorithmic trading, which often involve, obviously, a large team to actually deploy, and they have a hard time now figuring out who's the trader. And so that's why they've gone more and more to saying, listen, if you want to deploy algorithmic strategies, you got to get a corporate rate, a corporate membership, because we just, Phil and I've had a lot of clients, Phil and I can just say, hey, let's trade an account, and if we're both members, we can have a joint account, because the way the CME looks at a joint account is they look to who's got the lowest membership, and that's what we're going to charge you. And so long as we have the same membership, that's fine. But if Phil and I want to do that, well, let me back up actually. They would also let us form an LLC as long as the only owners were, again, the two of us and we were members, because they view that just like a joint account. But as we say, hey, well, let's start developing an algorithm, and let's start developing a black box, and we got to hire at least one clerk, and now we got to hire a quant, and now we got to hire a programmer, and now we better have a risk person. They start to see this go from being really a joint account to really much more of a firm account, and the CME doesn't have a bright line for that. We have a lot of conversations with them, but at some point they'll look at that and say, no, you can't rely on an individual membership or a joint membership anymore. You have to go to one of the corporate memberships. So it's something to think about, because their rules, again, I would say they're extensive and detailed, but then there's a lot of these blind spots that there's no way for you to see that their policy would move you in one direction or the other. The last, I think, topic, which I always end with this because it's so much fun, is regulation. And most proprietary trading firms feel like they're in this world of, well, I'm not really regulated. It's great. Put aside the broker-dealers and the market makers, but they mostly see, hey, other than maybe being a member of an exchange, I've got a great deal. I'm not regulated. I'm not a hedge fund, not a broker. I'm not an FCM, not a clearing firm. So, but there's a false sense there, because to some extent that's actually true. that if you are a proprietary trading firm and you have a limited number of owners and we're all active, and for the most part, out of all the regulation out there, we actually are exempt from everyone. And so let me just give you an example. Hedge funds are subject to a lot of regulation. So let's assume I'm a hedge fund that's trading equities and futures to a large degree. And I have clients, investors. Well, now I have to think about, well, maybe I'm subject to Investment Advisors Act, right? Because I'm advising that fund, and the rules changed with Dodd-Frank, and many hedge fund managers had to register as an investment advisor. And then, well, I'm running a pool, probably, commodity pool. So the rules changed at the end of last year as well, where they rescinded one of the main exemptions that hedge fund managers relied on. And now I'm advising, so just like having to be an investment advisor, I'm now a commodity trading advisor, so there's another one I have to register. And then the last one is, well, I might be an investment company, because an investment company, which is a mutual fund, is actually a business engaged in the business of trading securities. Sounds a lot like a prop firm. The exception is that if there's exemptions, that if all of your owners are knowledgeable employees or you have less than 100, then you're actually exempt under 3C1 of the Investment Company Act. So hedge fund managers are always sort of ticking those boxes and thinking about that. And proprietary trading firms think, oh, that doesn't apply to me. Well, generally you're right, because if you think about it, if Phil and I have a trading firm, you know, we're not worried about the regulators saying we're advising each other. That's not really an advisory relationship. And if we're trading equities, it's two owners, we're fine there, we have an exemption, I don't have to file for that. And on the pool, we take the position, well, a pool is really something that's in the nature of an investment trust or syndicate. So they really think about passive investors. We're both active, we're fine there. So that's where the market was. But then you start to change the facts a little bit, so we need a little extra capital, and we want to bring in one individual who's passive, who's going to invest in the firm, right? So now we're probably okay on a lot of those fronts. We maybe have a little more sensitivity around, are we advising this person? So maybe this person's active too. But now we get into a situation where we have a passive, or we have a pool now. That's a problem. And then maybe we say, let's go and get a private equity firm because we're doing well and we want a large infusion of capital. Now we have a private equity firm who's made a large investment. That also opens up the door of, do I have a passive investor where now I'm a pool? Permit ourselves to say, hey, even though we probably have an argument we're not a pool, let's just go file this exemption. It works for us. It's much more conservative. Let's file it. Well, then the CFTC rescinded, not because they had any interest in proprietary trading firms, but because they wanted hedge fund managers to register, mostly because the SEC did it, so they thought, well, we might as well do it too. But what you now had is proprietary trading firms who took the conservative route, filed the exemption, thinking, well, I don't have the exemption anymore. Now can I take a position that I'm no longer a pool based on the fact that we have passives? And there was two sides to the coin, because it was the proprietary trading firms that had to make that decision, but it was the clearing firm, like Advantage, that has what's called an 1101 obligation. So as a member of the NFA, a member of the NFA under bylaw 1101 cannot do business with another enterprise that they know should be registered with the NFA. It's basically self-policing. So now the clearing firms, to protect themselves, had to say, well, tell me why you're not a pool, and you need to convince me. So it wasn't that, well, we got a really aggressive lawyer, he'll let us take the risk, we're fine. It was now, well, no, now you have to convince the clearing firm, who's not going to use that aggressive lawyer, as to why you are exempt from registration. And so there was a lot of activity. We're aware of an unpublished, for some reason, no action letter, where there was a firm that had that proprietary trading firm, had that private equity investor in, and they were able to take the position that that private equity investor was active. They were helping develop strategies and were issued a no action letter. But most of the market is still pretty vague out there. And there's an open question both on the customer side as well as on the clearing firm side as to what's the exemption, what type of risk can we take, and on the clearing firm side, what type of proof do I need to get comfortable that I don't have the clearing firm an 1101 obligation. So I think as you, again, work through your structures, you just want to think that these rules that appear to only apply to hedge funds really actually indirectly apply to proprietary trading firms, and you just need to be aware of them. don't know if you have any other thoughts?
No, other than I agree with you, Lance, that you want to be careful that if you have a prop trading firm, the CFTC wouldn't say that you're acting as an FCM, which is basically where you're just clearing somebody's business and they're getting the benefit of a lower exchange rate.
Because remember, although CME has extensive rules, ICE does not, and many of the foreign exchanges do not. So you're not going to have that overlay, almost de facto protecting you from deeming to be an FCM if you're only hypothetically. Now, I don't know many people that trade ICE and not NYMEX, but if you're trading these other exchanges, you might very well be able to not rely on or comply with 80/20. As Phil said, be very careful about being deemed to be, in effect, engaging in a customer business. Because again, to do that, like Advantage, you got to be registered as an FCM.
An example of that, Lance, would be from a reporting standpoint, that let's say, for example, you have a proprietary trading firm, and the account would be in the name of the proprietary trading firm, but you give the trader a 1099-B as opposed to a 1099-M, which would give him ordinary income. In a sense, you're acting as a broker by just giving him the 1099-B.
And again, if people have thought that the clearing firms have gotten more active, it's because they sort of have to. Because when the TUCO issue came down that I spoke about, which was in effect running that unregistered broker, not only did they go after the principals, but they then went after the introducing broker and the clearing firm for saying you aided and abetted their violation. So what you now have are the clearing firms doing their own diligence, because there's been a lot of talk, especially, interestingly, more on the equity side, because the CBOs come out with a circular, the SECs come out with an alert, but the clearing firms are now worried that they are responsible. So we are aware of clearing firms that will audit every account and look at all the deals and explain to me why you are validly a proprietary trading firm and not running a customer business. So in order for them to protect themselves, they're doing audits. And again, you want to structure that well on the front end, not sort of when you're either have a regulatory inquiry or you're shut down by your clearing firm. So went through a lot of material here. Any questions?
Yeah, I have one concerning the 60/40 rule for exchange products and a firm that trades spot products where they have the individual traders. Some of them are a lot of times taking all their gains, on the spot side of things, and if they have their B share or whatever, the firm's able to pass them through 60/40 by kind of like, I don't know how, but they're maybe commingling some of those things.
Well, if they've made a mixed straddle election and they've accounted for it correctly, they could be allocating them as much as 50% long-term and 50% short-term. But absent a mixed straddle election and where there's just two distinct trading programs. Let's say one trades U.S. Treasuries, cash on Treasuries, and another group trades futures. That the traders for the cash would probably get short-term or ordinary.
Okay, so that shouldn't be able, because what happens is a lot of, if you take an interest rates firm, they're trading, a lot of treasuries or whatever in basis, and then they have other guys that are trading maybe short-term interest rates strictly, so they're pure futures.
Okay, well, let's talk about the basis for a minute. The basis, hopefully they made a mixed straddle election.
Okay.
Okay, and because on the basis trade, they're probably trading a derivative with a cash security.
Right.
And so they have a straddle, and the most efficient manner tax-wise to account for that would be a mixed straddle election.
You know that'll give them 50/50 instead of 60/40?
As much as 50/50.
Okay.
And again, it's a function of where the gain is. If the gain is on the cash side, then it could be short-term. Or it could be a mix, that most mixed straddle calculations come out that for a year there's a gain on one side and a loss on the other. But if you can think of a matrix, there's 4 different scenarios. There could be a gain on the cash and also a gain in the future, as well as, if they lost money, they could have lost money in both products.
Right. I didn't know if there's anywhere where they can add, like switch some of the gains from the cash over to it, you know, the guys that are just trading purely futures. And
It
kind
would
of
be a
swap
function
around.
of the operating agreement, and again, there's a number of variables here. If the operating agreement is such that where everybody shares in a percentage of the total firm as opposed to eat what you kill, that yes, that it's possible that they could be allocated Section 1256K.
Yeah, the one thing I would say is if you're sharing the overall, then typically you should prorata share on the character of the gain of the firm, right? If you're trading a specific account and a specific product, it's also proper, if you're only splitting on that income, to have only that character. What is not typically proper is to say I'm trading in this, I have nothing to do with that, but give me a special allocation of that character of that income.
So you're saying that's probably it.
That's our tax people aren't big fans of that.
Yeah, and it gets back to what we talked about a few minutes ago in terms of there has to be economic substance to the allocation method.
Right, and that's why in the instance where I'm only trading 60-40, so I only get 60-40, there's substance to that. But if I'm trading, you know, short term, and Phil's nice enough to allocate me only 60-40, he may be nice, but there's not any real economic effect there.
I've heard a lot of people use the term carried interest interchangeably with 60-40 treatment. Can you guys explain the difference between the two?
Well, they're related in the sense that Lance and I have a trading entity, and Lance is the trader. And historically, that as commodity funds developed in the 80s, 90s, that the trader would receive an incentive fee and also a management fee. The common fees were 2 and 20. And that I would pay it out of the fund to Lance, and Lance would pick it up as ordinary income, and I would pick it up as an ordinary expense. Starting probably in about the 90s, that the general partner of the fund or the trader said, well, gee, I'd like some of this 60-40 income. So instead of paying me a fee, I'd like you to allocate me income. And that allocation is what's called the carried interest. So that Lance, under a carried interest methodology, instead of receiving ordinary income for his incentive fee, he would get 20% of the profits, and they would maintain their same character.
And to put a just finer point on it, the carried interest is the method by which I receive an allocation of 60-40. And in carried interest, there's all these different terms thrown around. It's really market. So remember we talked about the profits interest? That's what a carried interest is. But carried interest and promote are really terms that were used in the private equity field. They like to talk about carried interest and promotes, incentive allocations and performance allocations, what the hedge fund managers use. And in the prop world, we just say your share of trading. Those are all the same thing as carried interest. That's the profits interest. And because you can issue a profits interest, i.e. the carried interest, that's how then I can be allocated the 60-40, which is the underlying character. Does that make sense?
I think a lot of the discussion regarding carried interest in the Senate Finance Committee and the House Ways and Means Committee wasn't looking at proprietary trading firms. What they're looking at is private equity firms where there's probably more long-term. And so where if the manager was an outside entity, he would be being paid ordinary income, where if he's getting a carried interest as a member of the LLC or of the partnership, he's receiving long-term. But again, we don't see carried interest going anywhere this year. But again, it keeps popping up.
I hear you guys saying that if you're issuing a 1099-B, that person under the rules for the CME better be a principal or have 250,000, that kind of thing. So
Yeah.
Well, then you get a K-1.
Okay.
Well, here, I think the CME use a 1099-B and a K-1 for their rules, it's the same. So, right, so all the rules that apply to a K-1 for the most part, but the 250 apply to a 1099-B.
Right.
Now, as a firm, we're not big fans of the 1099-B. We think if you really want to be conservative and pass on character, you should do it through a K-1.
Got it.
But CME views them mostly interchangeably.
Okay. So here's my question. You mentioned that instead of doing that, if it's just a trader, shouldn't be receiving a 1099-M, or miscellaneous, right?
Right.
It's ordinary income.
The ordinary income. At what point do you do a W-2 as compared to a 1099-M?
Careful.
Well, yeah, you go carefully to the M.
Yeah.
Yeah.
Okay, can you talk about that a little bit? or-
Ken, it has to do with an independent contractor role versus an employee role. And this is a very sensitive issue with the IRS. It has been for the last 10 or 15 years. Let me tell you a good example of when a trader should receive a W-2. I have a trading firm. I hire someone. He signs a contract. He signs a covenant not to compete. He acknowledges all of my trading rules. That he has to use my methodology and my order entry. I have control over him. He's thus an employee. That by making him an employee, it costs me, the firm, the payroll taxes, which are roughly 7.8%. Okay? Now, if I pay him as an independent contractor, I don't have those payroll tax expenses. He has self-employment, which is 2 times FICA, so it's disadvantageous for him. Now, what the IRS has said is if you have control over someone you are paying, he's an employee. If you're audited, we're going to reclassify him. But what makes it even worse is a couple of years ago they came out with a form that where I'm paid on a 1099-M, but I really think I'm an employee. So what I'm going to do is I'm going to fill out this form, and instead of paying the self-employment tax of 15.3%, I'm only going to pay half of that. And then, as you can imagine, the IRS will go back to the paying firm and say, gee, that you had an independent contractor that said he should have been treated as an employee. If you have control over the person, we suggest that you look pretty closely at making him an employee as opposed to an independent contractor. But here's an example of an independent contractor. I'm a trader. I trade for 3 or 4 firms. You know, I'm truly an independent contractor.
And where it typically comes up, it's not just on audit, is as Phil said, it's good for the firm, not good for the individual. But the individual can generally accept our ordinary income fine, I understand self-employment. But then let's assume that we have a problem with that person and we terminate the 1099. And they say, this is ridiculous, fine, I'm going to file for unemployment and I'm going to see what I can do. What do you mean no unemployment? I'm an independent contractor, I'm not eligible for unemployment. And that's when they maybe go to a lawyer and the lawyer says, oh, well, they should have classified you as an employee, and then you get into an issue. So it's a real issue in the industry, and some people believe you can just pick one, but as Phil said, you really can't.
And you can help them. You have a checklist too, right? Like,
There is.
So if the guy's coming into your office, and especially if you tell him, they have a whole checklist of items. If you tell him you have to come to the office every day, I want you here at 7 and you go home at 4, the more you specify specific things like that, the more he's going to look like an employee. If a guy's trading from home and you're like, hey, here's how we're going to cut your profits. You can trade whenever you want, your markets, you want to trade at night, trade at night. You want to trade in the day, trade in the day. You want to trade, your dollars, trade whatever you want. I'm going to pay you a percent. That starts to be a little more able to be an independent contractor. But I would advise anybody who's thinking about these kind of things to, talk to a Phil and you want to get a real opinion on it. You don't want to wing it. But there is a checklist you can go through. And his point, we actually got nailed a few years ago, and Phil helped us on this. We had a guy who was helping us out for a few months, and we had him sign an independent contractor arrangement with us. He was an independent contractor, making a few $1,000s a month to help us out for a few hours a week. Then he went and decided to sign this form that he's talking about with the IRS, claiming that he was not an independent contractor. And Phil helped us with the IRS, and it was ridiculous, and it went in our favor. But just some rogue guy.
But Joe, that was black and white.
I know.
I mean, there's no way this person.
But I'm just saying how some rogue guy can go and sign that, and then the Internal Revenue Service then conducts an investigation.
Correct. Then you have to respond. And again, that we've seen it. It's usually where there's some acrimony between the trader and his prior firm. We had a case where that the trader acknowledged in an agreement that he was self-employed and that he went to the IRS and the IRS went his way. They went his way even though that there's a signed agreement where he acknowledged it. It's the underlying facts showed that the firm had control over this person.
If the trader needs 250 up for CME, what if that trader owns their own seat? Can that be put towards the 250?
If they contributed into the firm, they might be able to get credit for it if it's a true capital contribution. Because they're talking 250 of capital. Now, they usually think of cash, but I have seen situations where you make an in-kind contribution with a reasonable valuation, and they might count that towards your 250.
Which is from our firm there.
But that's now, but remember, that's different. That means now the firm owns that seat, which is different from just pledging it, trading rights on behalf of the firm where you still own the seat. If you're actually getting credit for that capital contribution, you've assigned that seat over, and then implicitly you've signed over the appreciation or the depreciation. Now, there's ways to deal with that, but for the most part, it's
And
your
you
own.
wouldn't incur a tax by the contribution. That let's say you bought the seat for $100 or $100,000, it's now worth $250. That your capital account would be credited $250, but you wouldn't pay tax on that gain.
So with that, I want to pause right there and thank Lance and Phil for coming today. If you have further questions, I think they'll be hanging around for a couple minutes, and feel free to come up. But I want to thank everyone for coming today. Thanks very much.